Are you dreaming of owning your own home, but feeling overwhelmed by the mortgage process? You're not alone. Mortgages can seem complicated, but understanding the basics is your first step toward making that dream a reality. So whether you're a first-time homebuyer or just need a refresher, this video will break it down for you. Hey everyone, I'm Matt Sloan, a realtor here in the Greater Toronto area and team leader of the Matt Sloan team. If I could ask a huge favor, please subscribe to this channel and hit that thumbs up button if you like this video. So today we're talking about one of the most important parts of buying a home, mortgages and mortgage pre-approvals. By the end of this video, you'll have a clear understanding of what a mortgage is, the types of mortgages available, how pre-approvals work, and why they're crucial for home buyers. So if you've ever asked yourself questions like, how much can I afford? Or what's the best way to get started? You're in the right place. And if you would like to chat with me or book a strategy call at a time that works best for you, there's a link in the description below. Now, let's get into some of the mortgage basics. What is a mortgage? First off, let's answer the big question. What is a mortgage? Simply put, a mortgage is a loan you get to buy a property. Unlike other loans, though, your home acts as collateral. This means if you don't keep up with your payments, the lender can repossess your home. We don't want that. Now, mortgages have two key parts, the principal and the interest. The principal is the amount you borrow. For example, if you're buying a $500,000 home and putting $100,000, your mortgage principal would be $400,000. The interest is what the bank charges you for lending you that money. Over the term of your mortgage, these interest payments can add up, so understanding your rate is essential. Let's say you're a first-time home buyer looking at a house for $500,000. You're confident about your finances, but aren't sure how much of a loan you can handle. Knowing how mortgages work and understanding terms like principal and interest helps you figure out what's realistic. The last thing you want is to end up is a term we hear thrown around a lot, is house poor, where most of their income goes toward mortgage payments and you struggle with day-to-day expenses. Interest rates can vary based on the economy, your credit score, and the type of mortgage you choose. So there are also factors like amortization or length of time you'll take to repay your mortgage. But we'll dive into those concepts in just a little bit. So let's talk about the two main types of mortgages. We have fixed rate mortgages and we have variable rate mortgages. A fixed rate mortgage locks in your interest rate for the entire term of your loan. So your monthly payments stay the same. This is a great option if you prefer stability and want to budget with confidence. For instance, if you're the kind of person who likes to plan your expenses down to the dollar, a fixed rate might be your best friend. Imagine someone with a young family who needs to budget for school costs or daycare and groceries. Predictable payments make life much easier. On the other hand, a variable rate mortgage has an interest rate that changes with the market. When the rates are low, you can save money. But if the rates go up, your payments might increase. It's a risk-reward situation that can work well if you're comfortable with some financial flexibility. This might be more ideal for a professional in a growing career who can handle potential fluctuations and might benefit from the savings when the rates drop. Now, there are also hybrid mortgages that combine the elements of both fixed and variable rates, as well as other specialized types like open or closed mortgages. These options may suit different needs, so be sure to discuss them with your lender or mortgage broker. So, quick question. Are you team fixed or variable? Let me know in the comments below. And if you've had an experience with either, share your story. It actually might help others in the community. Before we move on to pre-approvals, let's quickly talk about amortization and terms, as these often confuse first-time homebuyers. Amortization refers to the total length of time you have to pay your mortgage. In Canada, it's typically 25 years, but it can be shorter or longer depending on your financial situation and goals. For example, if someone planning to retire in 15 years might opt for a shorter amortization period to pay off their mortgage faster, even if it means higher monthly payments. The term, on the other hand, is the length of time your current mortgage agreement lasts. Terms usually range from 1 to 5 years. At the end of the term, you'll need to renew your mortgage with the same or a different lender. It's an opportunity to reassess your financial needs and potentially renegotiate your rate. Think about someone who locked in a fixed rate and sees rates drop during their term. When renewal time comes, they can switch to a lower rate or even a different lender to save money. Understanding the difference between these two can help you plan better and potentially save money in the long run. Now, let's move on to pre-approvals. If you're planning on buying a home, getting pre-approved is a must. A mortgage pre-approval is like a golden ticket for a house hunting. It's when a lender reviews your financial situation and tells you how much they are willing to lend you, essentially. They'll also lock in your interest rate for a set period, which can be super helpful if rates are rising. To get pre-approved, you'll need to provide some documents, including proof of income, like pay stubs or tax returns, a good credit score, the higher the better, details about your debts, like car loans or credit cards, and finally, information about your down payment. Picture this, you're house hunting and you find the perfect home, but you don't have a pre-approval. Someone else who's pre-approved makes an offer before you can and even get your paperwork together, and this could result in losing the home. That's why pre-approvals are so important. They can allow you to act quickly and, most importantly, with confidence. Once you're pre-approved, you'll know your budget. You can start looking at homes within your price range, which is a huge confidence booster during the buying process. So why is pre-approval important? Here are two big reasons. First, it saves you time. Won't waste your energy looking at homes you can't afford. Instead, you can focus on properties that fit within your budget. Time is precious, so especially in a hot real estate market, it's important to be pre-approved. Imagine being in a bidding war and knowing exactly how high you can go without overstretching on your budget. That's the power of pre-approval. Second, it gives you an edge in a competitive market. Sellers take pre-approved buyers more seriously because they know you're financially ready to close deals. It's like showing up to a job interview with a glowing reference letter. You'll stand out. Think of a seller who's juggling multiple offers. A buyer with a pre-approval might be seen as less risky and more reliable, increasing their chances of acceptance. One tip would be, after pre-approval, avoid making big financial changes. Don't open a new credit card or finance that new car. Lenders will recheck your finances before finalizing the mortgage, and any major changes could jeopardize your approval. So what to do if you're not approved? If you're not approved, don't panic. There are steps you can take to improve your chances. Start by reviewing your credit report for errors and working on improving your credit score. Pay down existing debts and consider saving a larger down payment to strengthen your application. Picture someone with student loans or credit card debts who gets denied. They take a year to focus on paying down their balances and building up savings. When they reapply that following year, they're in a much stronger position and hopefully get approved for their dream home. You can also shop around. Different lenders have different criteria, so another bank or mortgage broker might offer you better options. It's always good to shop around. Just be sure to keep all inquiries within a short time frame to avoid hurting your credit score. If you do it too much, it might show on your report. So there you have it, the basics of mortgages and pre-approvals, plus a little extra to help you feel prepared. I hope this video helped you with the process and gave you the confidence to take your next steps. If you found this video helpful, please hit that like button and share it with someone who's planning to buy a home this year. And if you have any questions, drop them in the comments below. I'd love to hear from you and help out however I can. Don't forget to subscribe to the channel. I would really appreciate it. Next video, we'll be talking about how to save for your down payment. So you don't want to miss that one. Until next time, happy house hunting.